and welcome back to our channel KaleidoCAST. Did you know that numbers from 2022 indicate that there are over 58,300 publicly listed companies on stock exchanges? That means there are a lot of investment opportunities out there. However, when you add the number of private companies into that, it jumps up to 300 million companies. 300 million companies, that is a lot, and it really leaves you thinking, what sort of investment opportunities could one be missing out on if one fails to investigate the private markets? And with me here today to discuss the two types of markets, the private and the public, I have our very own Patrick Fehr, the Chief Investment Officer here at Kaleido.
Hi, Ina.
Thank you for being here.
Yes, of course.
Let's just start off with simply explaining what is a private market and what is a public market.
Yeah, let's define what a public market is then, because that's a bit easier to do. A public market is basically securities that are listed on a stock exchange that is heavily regulated and supervised by a national regulator. And there you can buy your Nestle shares or whatever in a regulated environment. Whereas basically the private market is almost everything else, no? Transactions that happen not on a stock exchange or another public environment, but rather in a private environment. And it's very regulated when it comes to the transactions, right? When you invest in a private equity fund, however, the fund structure is regulated like an equity fund, of course, yeah.
Okay. And what are some of the most fundamental differences between these two markets?
Yeah, differences are manifold. I mean, I would say ownership obviously is a big difference. The size of the investments, the liquidity that the structure provides, how to exit these investments is very much different. Risk reward also. And finally, also access to information of portfolio companies is certainly different, yeah.
So there are some major differences between these two.
Absolutely,
and I would love to hear some more about each one of those. Yeah. Could you deep a little bit digger into it?
Yes, of course. I mean, when we talk about ownership, obviously a private equity fund wants to have a majority stake in a portfolio company now. And why? Because the private equity investor wants to employ the management team he trusts, and he also wants to implement the basic strategy of the company, see also balance sheet structure and leverage. Obviously, the private equity fund manager wants to decide. And last but not least, also the dividend strategy is important now. For a private equity fund. And when we look at the public markets, if you were to buy some shares in Nestle, obviously, I think you would expect a decent return of the stock and some nice dividends that you can reinvest, and you would use your voting rights that come with the number of shares that you have. So this is basically a difference in ownership now. When it comes to investment size, obviously private equity has historically been an investment category for those with deep pockets. Yeah. So pension funds, sovereign wealth funds, ultra high net worth individuals basically invested as limited partners alongside the general partner, the fund manager, and they required significant amounts of investments, now 10 million plus, and this is certainly different in the public area. Depending on your minimum transaction cost, you can buy a handful of stocks of whatever company, right? Then also liquidity certainly is very different. No? When you invest in private equity, you usually buy shares of a fund, and the fund is a closed-end fund usually. It means it has a duration from today to 8 years, right? Or maybe even 10 years. And throughout that period, you cannot exit that fund. And this is certainly a big difference compared to your public markets when you, depending on the market, you can basically sell anytime, right? That's certainly different. Also, how you exit in private equity is certainly different. The fund manager at some point over the lifetime of the fund starts to exit the portfolio company, so he needs to find a buyer, or he IPOs the company. So these are the exit scenarios for private equity portfolio companies. Here again, I mean, same in public markets, the same with liquidity before. You exit your Nestle shares through your mobile app and type in an order to sell, and that's it, right? At any time. And in terms of risk reward, I would say historically private equity has experienced higher returns, but also higher risk. That's a very general comment, I have to say. And this is certainly also a little bit different from public markets. Also, I mean, it depends on what kind of stock indices you compare. But that's why I said it's a general comment, yeah. Okay. And then also access to information is different. No, as I said before, when a company is listed on a regulated stock exchange, this requires a certain amount of transparency. You have to file an annual report, you have to file quarterly reports. If managers of the company deal in their own share, they have to report it. Whereas in the private world, so to say, it can be pretty hard to find some data or get access to data from a private company. That's certainly another difference.
Yeah, some very clarifying points there on the differences. Thank
absolutely.
you. However, let's say that I were to be an investor that suits all of these criteria. And I have significant capital at hand, and I'm looking for some investments, either in public or private markets. What should I think about? What are sort of the pros and the cons of these two markets?
Well, the pros and the cons are manifold. No, I mean, public markets. I mean, the way we do it at Kaleido is, I mean, we tend to diversify your portfolio across asset strategies or investment strategies rather than asset classes. No, and this has delivered some pretty okay results over the last 1.5 years, I would say. Whereas in private equity, I think one of the cons, which is the lack of liquidity, I think it is also a pro, because you really need to lock up your money for 8 to 10 years. So this is basically the first screen. If you are not willing to do that, then it's not for you, right? And secondly, I think due to the fact that you have to lock up your money so long, this also reduces the risk of having negative returns. Because if you own a stock only for 1 month, I mean, the probability that you post a negative return is whatever 50% or so, and the longer your time horizon gets, the smaller the probability that you post a negative return. So that's why I think it makes a whole lot of sense to invest in private equity. Also, for us, it is important that we have a match of the liquidity of the fund to the liquidity of what's in the portfolio. And as you know, we have private companies in the portfolio that we basically start selling after year 5, 6 in the fund's life, and this is basically the liquidity match that we want to have, and we don't provide any kind of liquidity that's not there when you need it. So. Yeah.
That's interesting, and it can be quite complex to navigate all these financial terms and the financial landscapes. And of course, we at Kaleido Private Bank, we help our clients navigate this. However, you started speaking of it, but I would love to hear some more about how do we help our clients when it comes to investing in private and in public markets.
Well, in public markets, that's easy, you know. I mean, we also have stocks and funds and bonds and alternative products in the discretionary mandates. No, again, as I said before, we tend to diversify across investment strategies rather than in asset classes. which has been very beneficial in the most recent past. No? Private equity have teamed up with Petiol Asset Management, a FEMA licensed asset manager with offices here in Zurich. And we together going to launch the Kaleido Private Equity Funds 1, which we are very excited about it. And this is basically the vehicle where our clients can invest in private equity. The benefits are usually when you invest in a private equity fund, you basically get charged with management fees from day one for the committed capital, despite the fact that your capital is only invested after 1.5 or 2 years. Within our product, we charge only management fee for the funds of our clients that are invested, and so the money that sits on the cash account of the fund structure and earns income, we even credit that to the fund. And thirdly, also when you usually invest in a private equity fund, you see within the fund private equity fund 12 from this company, private equity fund 7 from that company, whereas in the Kaleido private equity fund number 1, you see really a stake in company ABC or a stake in company XYZ, and I think these are nice traits that our structure can offer to our client base.
Yeah, some compelling reasons. And I've heard a lot of positive things about this partnership with Petiol. And if you are interested in learning more about what Kaleido can offer within this area, or if you're just curious about learning more about investing in a PE fund, well, then we have a blog post on this very topic, and it's linked in the description below this video. So it'd be great if you want to check that out. And with that, I would just like to say thank you so much for this conversation, Patrick.
Thank you, Martina.
It's been great to have you here and lots of great insights. And I hope you learned something and that you can take actions on those learnings. And that's it from us today. Hope to see you next time on KaleidoCAST.